Fine. This is that when we are talking about the financing decisions. Okay? Fine. This is what the difference between the when we take into consideration the financial management and advanced financial management. Okay, advanced financial management. They are talking about the how the capital structure is the capital mix and capital structure. Okay, equity and optimum capital structure. You have one graph will be there where we are talking in terms of the calculation of the weighted average cost of capital. Okay, we are talking about the weighted average cost of capital. The point where the weighted average cost of capital is the lowest one, okay, is otherwise called as the optimum. Okay, optimum cost of capital. Okay, here at this point your debt is going to be 0. You will have equity will be 100%. Here the debt will be 100%, equity will be 0. What is the best capital mix? Okay, what is the capital mix and what is the capital structure in terms of, this is one thing we'll do. We are talking in terms of the what are the latest developments in the markets. There is a concept called as a dark pool trading systems. Okay, dark pool. We are having so many things here. Either we have a green financing, green financing is there, Islamic financing is there. I said Modi Glani Miller approach is there. Is that how the things will happen? When we are investing it, is that there are various options are there you will have. Is that you have various different, you have the equity, you have a hybrid financing. Okay, you have hybrid financing, you have a lease finance, venture capital is there. Okay, you have the business angel finance. Okay, very new concepts. Okay, where business angel finance, you have private equity, asset securitization, you have Islamic finance. Okay, you have Islamic finance, security token offering. We'll cover each and everything at a in detail. Is that now what we people will say? What is the role of development, Islamic financing? Is that why it has a growing source of finance in the organization? If you take European countries also, is that European countries also, if you take Western countries, the Islamic finance concept is more advanced, more preferable. Okay, more advanced, more preferable than other countries in the world. Okay, how it is going to be have impacted? Is that now when we do the things, is that we are also thinking about the green finance. Have you heard about this green finance?
I think for the agriculture, right?
For the environmental friendly projects. Okay, for the environmental friendly projects, sustainable. Okay, pursuing an environmental friendly means you have to give assurance that we are using the resources which are going to be environmental friendly. And the banks, in most of the cases, banks will provide the green finance. Okay, green finance. Is that will do the thing. Then you will have we are talking about financing the capital structure of the organization. These are the different approaches are there. Propositions, proposition, Modi Glani Miller proposition, before and after tax. You have a static trade-off theory. You have a pecking order theory. Okay, you have a pecking order of proposition. When we need finance, okay, when we say that when we need finance, you have a different options will be there. First you will take internally. Okay, first we will take internally. Then we will go for a debt, and last we are going for a equity. When we are saying internally, it will take into consideration retained earnings. Okay, internally this is the way we are going to. You have the Modi Glani Miller approach. You have the this is the approach. Okay, approach. They have a proposition 1. They have a proposition 1 and proposition 2. Okay, proposition with tax, without tax. Okay, with tax and without tax. Is that without tax? Okay, with tax and without that. They will also take into consideration, is it right? There is a perfect markets and imperfect markets. Okay, if you this is the core theory. Whenever we talk about source of financing, Modigliani Miller propositions, before tax and after tax, we'll cover this. And you have the agency effects. Okay? What is the requirement? Okay, what is the requirement of the management? What are the preference of the management, and what are the preference of the shareholders? Okay, what are the preference of the shareholder? You have to assess and advise the cost benefits of alternative source of finance with respect to at the international equity and bond. We'll also take into consideration is that we evaluate the alternative by obtaining how we have to obtain the stock market listing. Is it SPAC? Is it special purpose acquisition companies? You have different types of. You have a direct listings will be there. You have the Dutch auctions will be there, and you have a reverse takeovers will be there. Is it? You have a reverse takeovers will be there. Okay, these are the things which you are going to work out in detail. Are you clear about this? Is that a very comprehensive? It will take a lot of time for us to cover the things. Okay, it will take slowly and steadily. Will move from one stage to another. Okay, fine. They are talking about the we have done in the chapter 2 investment appraisal. Once we have done it, see, when investment appraisal, we will say that whether it is going to be accepted or whether it is going to be rejected. Based on what? Based on the NPV. Okay, based on the once we have done this, okay, once we have done this, then we should know if it is accepted. Then what we will say, our task is from where we have to get the sources of finance. Is that the sources of finance? You have the different options will be there. Is it right? Now, if we are talking about the financial system, you have the markets, institutions, and assets and liabilities. When you are talking about the financial markets, it is greater than 1 year and less than 1 year. Capital markets and money market. Wherever there is a doubt, wherever you are not having need more clarification, please let me know. Is that when we do the things collectively, they have the function. It is a channel of. It will channelize the funds. It provides the payments. It creates, more importantly, liquidity. That's very important. Is that what the banks are doing? Banks create liquidity. Is it that banks create money through increase? The more the lending, the more the liquidity provides financial services. Is that now what the financial systems are doing? Banks are also doing so many insurance services. They are doing multiple. Is that non-banking services? Is that they are also operating about non-banking services. Offer facilities in terms of investment banking. Is it right? They are also working with respect to hedging the risk, covering the risk. Okay. Now, they are talking. They gave you a small brief about the financial system. Include this. What is more important is the role of financial institutions. Is it the role of financial institutions? Is one of the things. Okay. You will have the financial assets and liabilities. What are the capital markets? What are the money markets? What are the commodity markets? There are commodity markets with respect to the oil, metals, anything is a commodity market. You have a derivative markets where we are talking in terms of we are thinking in terms of financial risk, options and future. You have the insurance markets, okay, redistribution, reinsurance, okay, reinsurance, risk, transfer of risk, and you have a foreign exchange markets. See, these are all the way where we can explore, okay, we can explore how based on the products or services which we need. Each sector in the economy will have the people who have the surplus and people who have the deficit. Bank is what the banks are doing. I'm just taking a general example. Bank is doing nothing. Okay, bank is doing what? Bank is acting. Okay, bank is acting as a facilitator. Somebody will have surplus money, somebody will have a shortage money. Okay, somebody that is what the concept. That is the complete concept. In our syllabus, we focus on long-term sources options. Okay, short-term sources are not normally used to finance long-term projects. Okay, long-term. We in our we very clear. We are focusing on long-term financing options. Okay, now coming back to this. Okay, what is the theory? What is the considerations? Okay, what is the thing? When you are raising the finance, it is not one thing that matter that will influence. Okay, it is a service cost. Service cost means what you are going to pay, the interest. Issue cost will be there. What is the combination of debt and equity? Okay, optimal capital structure where the weighted average cost of capital should be minimum. Okay, where the availability of finance. See what is happening now. You are talking about the taxation. Now we said where the tax is more, where the tax is less, where we have to raise the finance. Is it right? In one of the questions we have done the inflation. In which country there is high inflation? In which country there is a less inflation? Is it where the taxes are more, where the flexibility is there? Okay, people will say that come and invest. You will come across so many countries. Come and invest here. Okay, come and invest here. They provide lot of facility. You have the cash flow profile in terms of the inflows and outflows. We will also take the risk profile and what are the convenience, what are the guarantees we are going to work it out. It means raising finance is not just a one simple process. Is that you will have multiple sources. Set criteria for future such as achieve or maintain a gearing ratio. They will say very clearly, okay? They say very clearly that the gearing ratio will be 40%. Means you have to manage within 40%. Okay, you have to balance it. Is it focus on certain sources only, where we want debts, we want lease financing, we want institutional financing, you want equity financing. Is that what is the certain people say that I will take only debt. They say that I will take debt only from the financial institutions. Okay, private financing, is it green financing? That you have to be very specific. Review key ratios before selecting. When you are talking about key ratios, is it in terms of what? Not only in terms of debt equity ratio. Is that you are talking about these are the ratios which will influence. You will talk about the interest coverage ratio. Is that you are talking about the interest, all the ratios. Is that we have to link. Even if as a matter of fact, if you say that key ratios, they will not ask, but you should know how it is going to be affecting the dividend payout ratio. Is that you have to link. If they say in the question, they will say that these are the things and it is impacting. This is the capital structure very clearly. This is the capital structure and it is going to impact the dividend payout. Then you have to relate the capital structure specifically with the specific ratio as mentioned. Okay, mention. It's very specific, very easy, interesting, more importantly, interesting. When you are talking about the thing, we are talking about the debt is cheaper, okay? Debt is usually cheaper. Is that very important? Is that it is how much you will get at the rate of 5%. But what will happen? Equity, then equity. Okay, equity characteristics of equity is that if profits are more, okay, you have to pay dividends more. If there is losses, there is no dividend. That is the reason. The equity is more risky than debt. Debt is guaranteed. Okay, debt is guaranteed with respect to the interest payments, and debt is also having the advantage of tax. That tax you have that is the reason. Profit before interest and tax. First you will deduct interest. Then you will say profit before tax minus tax and profit after tax. Is that when you are issuing the debt or when we are raising the debt, the cost of raising the debt is usually lower than the issue of the shares. Okay, cost of debt is only what will happen. What will happen? Maximum you have to processing of the loan cost you have to do. But when you issue the shares, you will have the process cost, stock exchange fees, stamp duties, underwriting fees. Okay, investment processing fees. So many things will be there. Okay, gearing. Debt and preference shares gives rise to, see, very specific. Debt and preference shares give rise to fixed payments. Is it? Not equity. Because they say, when they say preference shares, they say they will also prefix the preference shares 8%. Okay, they say 8%. Debt is also, they say it is going to be 5%. Very specifically. Okay, cumulative, cumulative preference shares, non-cumulative preference shares, all those things. That is secondary thing. Is that must be made before ordinary dividend, shareholder dividend pays. Okay, what is the optimal capital structure? Is that optimal capital structure is where we are having the minimum weighted cost of capital. Okay, where the cost of finance, right, where the cost of finance will fall to a minimum point. If R value is less, automatically NPV, present value, will be more. We have to think about all the options before we work it out. What are the availability source of finance? Is that not all firms have the luxury of selecting capital structure. Okay, or everyone will not have. See, you in some cases, is it that if the some cases some companies will come and say that they will come for negotiation, and as a banks you don't want to lose those companies also. You don't want to lose those companies also. You want to get associated with those companies. Then definitely there will be a win-win situation. That is the reason. Not all firms have the luxury of selecting capital structure. More basic concerns such as persuading the bank to release further funds, current shareholders to make further investment may override thoughts about the capital structure. Very focusedly from your job profile. Very specifically about your job profile, how it is going to be worked out. Tax position. There is a tax benefits for debt only remain available. While you will have you have a tax allowable depreciation when you are taking the debt. Just now I have written, is it right? You have debt has the tax advantage. Okay, debt has the tax flexibility. Some firms operating in high risk industries usually may use mainly equity finance to gain the flexibility, but not to have to pay dividend should returns will fall. High risk industries, okay, startups are there. It is a high risk industries. Okay, some technology based, it is high risk industries. In some cases you have the exports. Is that you have the exports and imports. Is that if it is you are having export, this is what happening nowadays when the tariffs are increasing. If tariffs, we are some countries are mostly imports. Okay, some companies are very exporting countries. Immediately, what will happen? You are imposing the tariffs. Okay, you are imposing the tariffs. What will happen? Your revenue, if you are imposing the tariffs, your profits will decrease. If your profits will decrease, automatically what will happen? The dividends will also decrease. High risk industries. If any country is having, that is the reason very clearly why China is export oriented in the country. Okay, China is an export oriented country. Now they know if they want to, in order to protect their countries, they protect the companies within the country, they have to have a relations where the other country will not impose tariffs. If they are imposing tariffs, automatically, see, it will affect both the countries. It is not going to say that it will affect one country. If we are increasing the tariffs, the cost will also increases in the home country. That is where we are talking in terms of the high risk. Cash flow forecasts are central to finance decision and ensuring two sources of finance do not mature at the same time. Is that what will happen whenever you say you are taking different types of bonds, okay? You are taking different types of bonds will have a different duration. Different types of bonds will have a different duration. Definitely, though two things will never going to mature at the same time. Is that now? These are very, very clear. Okay, what business failure can have a far greater impact on directors than on a diversified investor. Is it directors? What they say, business failure will have on the director. See, when you are appointing a director, you will see the profile of the directors where they have worked. Is that where they have worked? See, directors are very cautious whether we should borrow or we should not borrow. It may be argued that directors have a natural tendency to be cautious about borrowing. This is the conflict, okay? This is the conflict that will be there, and we have to highlight these points in our answers. So we have to highlight these points as you wish, okay? You have all the flexibility. You have to make sure that how it is going to be given a good weightage to your presentation. COVID, there are some restrictions imposed. Okay, definitely, what will happen? You cannot see either by the internally or by the agreements. Okay, there is a restriction that you cannot. The management will say, the shareholders will say that you cannot borrow more than 40%. Is it? Now, if you have already, then automatically you have to work within those constraints. You cannot breach that constraints as such. Or sometimes what will happen, banks will also impose some conditions. Okay, what are the conditions? They say, see, if you are taking the loan, bank will say that, see, we are not talking about a small institution, we are talking at a global level. Okay, we are talking, banks will say very clearly, during the phase of your loan, you have taken a loan for 5 years. Assume you have taken a loan of 15 years. Then the bank will clearly say that for the first 5 years, okay, for the first 5 years, you should not pay no dividend payments. No dividend payment. That's all. As simple as that. Okay. No subsidies. Okay. You should not subsidize. These are the conditions they will impose. Okay. They will impose on the companies. It is called as a covenants. Now, theoretically, are you clear about this? These are the points which we have to highlight it. That's all. Nothing is there. Okay. Based on, we are not saying that you have to highlight 10 out of 10. You are highlighting 5. That's more than enough. Okay. The main capital structure theory assesses that in which the change in the capital structure will affect the WACC. We will cover WACC in the chapter 6 in detail. Okay. We will cover WACC in chapter 6 in more detailed way. Okay. That until later in this text. Okay. Fine. Now, what we are talking about when we take into consideration why debt is cheaper, you have to make sure it has a lower risk, and lower risk in terms of what we have to pay the debt interest before you pay any other expenses regarding dividends, okay, and definitely it will have a lower rate of interest. These are the characteristics. Is it? So we might expect that increasing the proportion of debt finance will reduce the debt. We might expect. See the thing. I am putting that one. Okay. Again that I am putting that one. This is what it says. Here the debt is 0. Okay. That debt is 0. The equity is 100. Here the debt is 100. Equity is 0. You will not get anything free of cost. You have to pay down payment. Okay, we have to pay down payment. No bank will give you loans unless you have 5 years financial statements. Okay, no bank will give. Bank will assess how much loans you are having. Is it that when you are assessing the cash flow statement, bank will evaluate how much you are talking in terms of your financing activities. In operating activities, they will say how much you are paying interest. In financing activities, how much you are paying the loan principal. Is that bank will have a complete picture. Is that second, increasing the level of debt makes equity more risky. Is that equity increase? See, when you increase the level of debt, okay, there is a fixed commitment paid before. You have to pay when you increase the equity. Automatic debt. When you increase the debt, automatically what will happen? Your interest expenses will increase. Simple concept, simple language, simple understanding makes things very easy. So increasing the gearing, is it right? Increases the cost of equity. This is the big statement. Increasing the gearing means increasing the loan will increase the cost of equity. If it is increasing the cost of equity, it is increasing the weighted average cost of capital. Very specific statement. Are you clear about this?
Yeah.
Now that is the reason, is that people will not use. There are some companies will be there, zero debt companies. Okay, there are so many companies are there. We have a zero debt. There are some companies that we are having heavily dependent on debt. Okay, dependent on debt. This point we have to make a interpretation. Is that this is the one we have to think. You can write 10 lines, 10 sentences on this. Okay, we have to write. That's very important, isn't it? The reduction in WABC, how the weighted average cost of capital will have the cheaper debt. When you will have the cheaper debt, when you don't have, see, when you have the amount of debt, is it right? When you have the amount of debt in the total capital structure, is that in the total capital structure will be less. Is that total capital structure will be less. That is the reason the banks will evaluate. Is that what they will say? What is your risk profile? Existing, how much loans you are having? That what they will say. Increase in WACC caused by a increase in the financial risk. In the cost of equity. Okay, cost of equity. Is that increasing means if weighted average cost of capital increasing, is that your debt will increase. Okay, your debt will increase and it will have impact on your equity capital. When your debt is increasing, the most difficult part is what? It is your interest payments. The point, as a banker, you should assess The moment the clients are defaulting on interest payments, you have to be very, very active. Okay, you have to be very, we will cover in detail at a micro level, okay, in detail at the micro level. This is what it has been, I told you, is it right? You have a traditional view, okay, traditional, low level of gearings, high level of gearing, very high level of gearings. If it is, see, people are there, is it right? See the thing, you understand, you are in the business, can understand. People will use credit cards, okay, people will use credit card. People, I'm giving a small example, okay, I'm giving a very small example. People will use credit cards, companies will use credit cards. In some cases, they will withdraw money, cash from credit cards. Most, that is, they will, is it right? They will take loans, is it right? They will take loans to repay loans. When they are taking the loans, they will take the loans at a higher rate of interest. Okay, they are taking the loans at the higher rate of interest. These are the things that will lead to bankruptcy. Is that at the low level of currency, equity should see risk increases. Equity holders see risk increases marginal as gearing will increases. Fine, to the minimum extent you can work it out. See, that is the thing. They say that I'm giving an example. You pay 20% down payment. Okay, they said 20%. How much you are going to say? People will not go for a 20%. You have to increase the down payment. The more you increase the down payment, the financial risk will be less. Is that the financial risk will be less. We have to see how it is going to have impact on your financial risk. Okay, at higher levels of gearing, equity shall become increasingly concerned with the increase in the returns. Debt interest paid first. Is that debt interest paid first? The moment you are increasing the gearing, that is the reason. That is the reason we should assess. Okay, if people want loans, fine. To some, we will put a cap on the amount. Okay, we will put a cap on the amount. They will say that there is some threshold will be there. Practically think threshold will be there. Then you will say that yes, beyond this we cannot. You will calculate one formula in the banking which will call a debt burden ratio, something you will calculate now. Which formula this ratio is there?
In debt service coverage ratio.
Debt service coverage ratio. Okay, debt service coverage ratio. Okay, so these are the things which has to be taken into consideration. This is well explained. Is that very, very clearly? Read this. You will find a very, very interesting. Wherever there is a read symbol like this, make it a point. Read the concept. Is that it makes things. When we do the things, okay, you have a cost of equity. You have a cost of debt will be low. Okay, cost of debt will be, assume I am taking an example. Okay, cost of debt will be 5%. Cost of equity is going to be 15%. When we do the thing, there is a weighted average cost of capital. It will be around, I'm taking as an example only, okay, we will do, it will become how much? 8%. Based on what is the weighted average cost of capital formula? Any idea?
I don't remember the formula.
Weight of equity into cost of equity. Is it right? Plus, is that weight of debt into cost of debt after tax. We go further, but this is the basic one. Okay, this is the basic one. Is that weight of debt times proportion of equity into cost of equity, proportion of debt into cost of debt after tax. What we'll say, we will see the thing, we will see the point x. This is called as a optimal level. The lowest point, okay, the lowest point is the optimal level of debt. Is it clear to you?
Yeah.
Fine. Now, you have another concept, Modigliani Miller. Okay, this is the core theory. Okay, Modigliani will with tax concluded, because the tax advantage of issuing debt finance, firms should increase why companies will take debt. That is the most important. Is that why they say that this is a tax theory? Is that there is a tax relief on debt interest? Is it? There is a tax relief. Now you see the thing. I will put three different options. Option 1, option 2, option 3. Okay, this is, I am talking about the debt equity. Okay, here the debt is, I am just taking a 300. Here the equity is 700. Here the debt is how much? 600, 500 and 500. Okay, 500 and 500. Here the debt is how much? Debt is 800 and equity is how much? 200. Take the example. Okay, we have an assumption. Debt is how much? Debt is going, in all the cases, debt is going to be 10%. Tax rate is how much? Tax rate is going to be 20% for our convenience. That you have the profit before interest and tax. Okay, profit before interest and tax. In all the cases, profit before interest and tax is 500, 500, 500. You are paying interest. Okay, you are paying interest. How much you will pay interest? Here you pay interest of how much? You pay interest of 30. 300 times 10%. Okay. Here you pay interest of how much? 50. 500 times 10%. Here you are paying interest of how much? 80. Then you will get what? You will get profit before tax. Is it? How much is there? Here it is 470, it is 450 and it is 420. Then you are going to pay tax, okay, for 20%, 47, 47. How much is there? 94. Okay, it is how much? 90. Okay, it is how much? 84. Check again my calculations. Is it? Check again my cal. This is the one. Is it? Tax is how much? Here we are paying 10% interest. Here for all. Here we are paying 20% tax. Profit after tax. How much is there? Just tell me fast. 470 minus 94.
376.
376. Okay, 376. Here how much is there? 360. Okay. Here it is how much? 420 minus 84.
336.
336.
6.
Okay, 3. Now, if you understand this, now you will understand everywhere. Okay, you will understand. Now, okay, now you take into consideration earning per share. Okay, is that how much is there? How much is? Take 700. Okay, take 700 shares. Nothing will happen. Is that 700? 700 divided by 376. Is it 500? Okay, sorry, 1 minute. Is it? Is it? This is what this is going to be. This is going to be profit after tax divided by number of shares. Okay, 376 divided by 700. Okay, here how much is there? 360. 360 divided by 500. Okay, and 336 divided by 200. Check. How much you'll get?
$0.53.
Next.
0.72.
Next.
1.68.
Now you evaluate. Is it that when you have when you are having debt is less, when you have debt is less, okay? When the debt is less, see, is that when the debt is less, the tax paid is more. Are you clear about this? How much you are paying?
Yeah.
How much you are paying? 94. Is it? When the debt is more, okay? When the debt is more, 800, you are paying less tax. Is that when the debt now? When the debt is less, okay, you are paying less interest. How much you are paying interest? You are paying interest of only 30. Financial risk. When the debt is increasing, you are paying. This is the financial risk. This is the financial risk. Understand? This is where you should understand. Okay? This is why we have to understand how much it is going to be, work it out. Okay? How much you have one side, is it at another point, okay? Another, if debt is less, okay? If debt is less, what is the if less? Interest will be less. I will not put interest, okay? I will put interest in the, I will say that financial risk is less. Within brackets, for your understanding, I put interest. Is it? Now, so many things, okay? You can conclude from a different aspects, is it right? If the debt is less, okay? If the debt is less, what is happened? The EPS is less. If debt is more, okay? If the debt is more, EPS is high. We are not only covering this is not there anywhere in the textbook, okay? Anywhere in the textbook. But whatever the theoretical points they are telling you, those theoretical points you have to relate this, okay? It gives you a complete, okay? It gives you a complete picture about the way they are making the assumptions, and we are relating those assumptions with the numbers, and we are proving that whatever they have given in the low level of gearing, high level of gearing, highest level of gearing. Is that anything happens, keep it in mind, anything happens, you take in other interpretation, how much the shareholders will lose, only, this is the financial risk. We are talking about the financial risk with respect to interest. We are talking about the financial risk with respect to what? We talk about the financial risk with respect to the amount invested also. Amount invested, anything happens, if there is a bankruptcy, how much the shareholders will lose? Shareholders will lose maximum 200. Bank will lose how much? It will lose 800. Financial, here also you take you relate the statement. Here also the financial risk is more. Here also the financial risk is more. Financial risk is more both in terms of interest payments as well as the principal payments. You see the thing. Now, you are investing how much? As a equity, you are investing 200. You are investing less. Your EPS is very, very high. Why companies go for a gearing? Why companies borrow loans? There is a reason. There is a logical reason. If you are borrowing more, your EPS will increase. If you are not borrowing more, your EPS will be less. Is it? Now, what will happen? Put the things. Is it? If equity is more, okay? If equity is more, is it? EPS will be less. Is that equity is less? Okay, what will happen? EPS will be high. You have to understand this. That's the only thing. Okay, we should have a clear picture about this. It's not only just we are talking in terms of the statements. We have to convert the statements with numbers and we have to make a conclusion. Now, when we do this, there is what we have said, there is a agency cost will be there. Okay, there is a agency cost. Is it right? There is a agency cost. Management doesn't want to borrow. Is it? Management doesn't want to borrow. The moment you are borrowing, financial risk. See, you are borrowing, now you see the thing. What is the thing, what happens? You should make an interpretation. I'm giving you a complete picture. The moment you borrow, okay, the moment you have borrow, you have to have a investment avenue. You should know what are your prospects of investment. When you are borrowing, definitely the pressure will increase for you to generate revenue in order to pay the interest expenses. This is the cycle that happens. You can add some more things in between. The moment you are borrowing, what will happen? There will be your financial risk will increase, both in terms of payments of interest as well as with it. Now management resist itself from borrowing, whereas shareholders say you have to borrow, because if there is something happens wrong, shareholders will lose less. Are you clear about this? These are the few points of interpretation with respect to the capital mix and capital structure. Are you clear about this?
Yeah.
Okay. This is now this is the way. Wherever it is possible, I will support with a very clear examples and with a conclusion. Now, what happens? We will say with a tax, without tax. Okay, with a tax, without. If it is no tax, how it is impact? If it is a tax, why we want to have that tax? Wherever there is a tax, people will prefer to borrow. Is it? Now, when we do the thing, Modigliani-Miller theory, the starting point for the theory, the investors are rational, balanced. The required return on equity is directly linked to the increasing the gearing. Gearing increases, cost of equity increases. Assume, we are not talking about the EPS, assume, just for our assumption, think it is a cost of equity. Think, just we will not calculate right. Think, if the gearing increases, what will happen? Your EPS is also increasing. The cost of equity, you have to pay more. What is given in the statement, you relate to the numbers, it will be 200% compatible. However, this is adjusted to reflect direct debt interest is tax deductible, so overall cost of debt is lower than MM. Debt is taxable. Is that debt is tax deductible? Then, if debt is tax deductible, what we are doing? If debt is tax deductible, how much we are paying? We are paying lesser tax. More debt, less tax. Okay, more debt, less tax. They are saying no tax, where there are no tax sector. Lower debt cost implies that the returns for the same level of gearing giving smaller increase in cost of equity. Lower debt cost, okay, less volatility. Lower debt cost. Debt cost is how much? 30. Is that debt cost is how much? 30. It gives you cost of equity also less. Now you see the thing, at least we can, if you can analyze this table, we can analyze all the points. I'm not taking one or two. We can come to a conclusion which will coincide all the points related to how the statements are there. The increase in cost of equity does not offset the benefit of a cheaper debt. Is that if you are increasing the cost of equity, is that the increase in cost, we can say the cost of equity is 20 to 30%. It is not going to have any benefit of a cheaper debt. Is it? Because what will happen? Weighted average cost of falls as gearing is increased. Weighted average cost of, see what will happen? You are, see now that's what I say. Is that we are talking about the weight of equity, cost of equity. Is that weight of debt into cost of debt after tax. Okay, weight of. Now assume, take an example. Weight of first option, how much is there? 20%. Is it 20 per 0.2 times 0.10? Okay, 0.2 times 0.10. Okay, 0.2 is the weight of equity, cost of equity is 10. Is that plus? Okay, plus. Is that weight of debt is how much? Automatically it will be 80%. Is the cost of debt will be after tax, it will be much lesser. Assume it is going to be 0.03. How much you will get? Tell me fast.
$0.528.
Check. .4%. Check.
Yep.
Okay. Is that now you take that in? Is that increase in the cost of equity does not offset the benefit of a cheaper debt? Is that if you take into consideration increase in the cost of equity 0.2 times 0.20, okay, plus, okay, 0.80 times, okay, 0.80 benefit the cheaper cost of debt, okay, we will take into consideration 0.02. Okay, how much you will get? 0.04 plus 0.016. It comes to how much? 0.056 or 5.6%. Check again.
Yeah.
Fine. Now, we have not changed the gearing. Okay, we have not changed the gearing. We have not changed the gearing. We have to change the gearing. Okay, we have to change the gearing. I will put another one. Okay, 0.4. Okay, 0.4 into 0.20 plus 0.6 times 0.02. 0.4, it comes to 0.08 plus 0.6 into 0.012, 0.092. The increase in cost of equity does not offset the benefit, does not offset the benefit of cheaper debt, and therefore the weighted falls as the gearing is increased. We have to realign it, okay? We have to realign it. It's not matching with what we have done, okay? Just keep it in, no problem, okay? Just keep it. Fine. Now what happened? This is what it says. Gearing up reduce the weighted cost of capital. The optimal capital structure is 99.9% gearing. Is that the optimal capital structure is 99.9% gain? Is that what will happen if we are making the things as such? Is that put it in the number, then only it makes things very clear. No, it is not there. No problem. Okay, we will cover this in practical terms. Okay, we cover this. This is a, what is VU? Any idea?
Which one?
VU.
No.
Value of unlevered firm. Okay, value of unlevered. Unlevered firm is nothing but debt is going to be 0. Okay, cost of equity unlevered. Cost of equity, G means, again make it a point. Cost of equity, G, value of geared firm. Okay, value of geared firm. Okay, cost of equity of geared firm. Okay, cost of equity of unlevered firm. That is the reason. What I say, not mentioned. If we have mentioned, we at next time, if time will come, I will say debt is going to be 0, equity is going to be 100. Debt is going to be 100, equity is going to be 0. Is that you do like this? Okay, you do like this, and you see how, and you make a comparison. You add one column, second column, you add debt is equal. Write down debt is equal to 0, equity is 1000. And debt is going to be 1000, equity cannot be 0. Understand point? Equity cannot be 0. There should be, that is the reason. What they have mentioned here, they have mentioned clearly. The equity will be how much? The equity will be the debt will be how much? 99.9.
Why it cannot be 0? Because there will be the paid-up capital will be considered.
Yes, 100%.
If there are no shares.
Yes, is it right? If how we can expect that without equity the firm will exist? Is that we cannot expect any business that will be existing without the component of equity. There will be one component of equity. I want to buy a car. Can I get a car without down payment?
No.
The same thing here. Is it the same thing here? Is it clear to you?
Yeah.
Is it interesting?
Yeah.
Fine. Now, okay. So now what they say in practice, is that in practice, wherever you want to stop, tell me, I will stop. In practice, otherwise at 10:45 I will stop. In practice, firms are rarely found with high level of gearing. See, as a credit risk manager, you will immediately, your eyes will be focused how much loans they are having. Immediately see that what is the gearing. Is it right? In practice, really very high level of gearing as advocated by MM. This is why there is a bankruptcy risk. There is a agency cost. The difference of opinion between management and shareholder. Tax exhaustion. Okay, how much is the tax you are going? The impact of borrowing and debt capacity. Is that to some level we can pay? Is it right? To some level, that is why we are saying it is a cutoff. We are putting a cap. Okay, we will have a cutoff. You will have a cap, so that you should make it a point. Difference in risk. That is the reason. You see the thing. Most of the people will don't wish to approach a bank. Most of the people will wish to approach a finance companies. There are so many concepts are there. Is that even the cost of risk is high? Fine, but their finance companies will take a higher risk and they will charge. Okay, there is a restriction. Any internal restrictions are there. Okay, any internal restrictions by the management, automatically it may increase in the cost of borrowings. As cost of borrowing will increase, as the gearing will increase. As a result, despite the theories, gearing levels in real terms tends to be based on more practical consideration. Okay, that more means different. They are given, okay, they are given you the read each, they talk about the restrictions, agency cost, what are the conditions with respect to the dividends, additional debt. They are talking about the taxation concept, borrowing capacity. They gave you the explanation about each and everything. Is it clear to you?
Yeah.
Can I stop now?